What if every financial crisis we have ever lived through was not an accident, but a scripted sequence that repeats through history with chilling precision? What if the same 7 acts that shaped the Tulip Mania, the South Sea Bubble, the Great Depression, the dot-com implosion, the subprime collapse, and even the rise of modern fintech are unfolding again right now, right beneath our feet? And what if we are entering Act 4, the point where illusions start to fracture, yet the majority still believes everything is under control? These questions unsettle because they expose a possibility most people try to avoid: that the economy is not driven by rationality, but by patterns of manipulation fine-tuned over centuries. If you pay close attention, you will notice the same choreography repeating again and again: a spark of innovation, a wave of optimism, an engineered expansion of money and credit, a quiet shift in power structures. Then come the warning signs, disguised as temporary instability. And yet, every time, people convince themselves that the system will magically adjust. But history is blunt. It does not negotiate with denial. The 7-act sequence has never failed to complete its cycle, and the societies queuing in Act 4 often do not realize that the turning point is already in motion. Right now, you may be sensing it too: the strange tension in global markets, the oversaturation of easy credit, the aggressive monetization of innovation, the increasing dependence on digital infrastructure. It feels new on the surface, but at its core, it is the same script performed with new actors. This is why understanding past crises is no longer optional. It is the difference between interpreting the signals or being caught off guard when the next sequence unfolds. So let me ask you something. Have you ever felt that the financial world moves according to a logic that is never explained to regular people? That there is a rhythm behind the chaos, a pattern behind the noise? What you will uncover throughout this video might surprise you, and perhaps even change the way you look at every economic event happening today. If any part of this introduction has resonated with you, share your thoughts in the comments. Tell me if you have ever lived through moments that made you question the stability of the system. And while you are here, make sure you leave your like and check if you are already subscribed to the channel, because understanding this content is essential to navigate what is coming next. Now breathe in, stay with this line of thought, and let the next part guide you deeper into the sequence that has shaped centuries of financial rise and collapse. When you trace the origins of any major financial cycle, something becomes clear. The first act never looks dangerous. It rarely feels like the beginning of a sequence that will later reshape nations, wipe out fortunes, and expose weaknesses hidden beneath decades of confidence. Instead, Act 1 usually appears harmless, almost innocent. It begins with an idea that seems promising, a discovery that opens new possibilities, a resource that suddenly becomes valuable, or a technology that shifts what people believe is possible. This was true in 17th-century Netherlands, when a simple flower bulb sparked unprecedented fascination. It was true in 18th-century London, when maritime expansion inflated dreams of wealth from distant colonies. It was true during the Industrial Revolution, when new machines promised prosperity without limits. And it remains true today, as modern markets adopt innovations that appear safe and empowering on the surface. What people often overlook is that Act 1 creates a psychological foundation, not an economic one. It establishes a story, a belief, a sense that something extraordinary is about to happen. And because human behavior is consistent across centuries, this early spark spreads quickly. Merchants, politicians, families, investors, banks, everyone begins repeating the same narrative. They tell themselves that they are witnessing a rare moment. They reassure each other that opportunity has finally arrived. This is the beginning of the emotional buildup that will feed the next stages of the sequence. But beneath this optimism, subtle pressures begin to form. New interest groups emerge. Early beneficiaries of the trend become influential voices, shaping conversations and expectations. Markets start adjusting to accommodate the rising enthusiasm. Some individuals gain power simply because they were early, and they use that power to reinforce the belief that the cycle is just beginning. None of this looks dangerous at first. In fact, it feels like progress. And yet, Anyone who studies crises knows that when a society becomes emotionally aligned with a single narrative, Act 2 is already preparing its entrance. You might recognize the pattern in the present moment as well. Whenever an innovation gains traction, whether in technology, currency, communication, or production, the same environment forms around it. Excitement grows faster than understanding. Confidence grows faster than caution. And slowly, almost invisibly, the first structural distortions of the cycle begin to take shape, guiding us toward the next transformation. As the initial spark evolves into widespread enthusiasm, the transition into Act 2 begins almost seamlessly. It is the moment when optimism stops, being a quiet belief shared by a few early observers, and becomes a collective conviction. People no longer ask whether the new trend will work. They only ask how fast it will expand and how much wealth it will generate. This shift marks the birth of fabricated euphoria, a phase where perception becomes more important than fundamentals, and where confidence is intentionally amplified by those who understand the mechanics of influence. During every historical cycle, this second act follows the same emotional curve. Prices rise not because value has truly increased, but because belief has intensified. Investors interpret this rise as proof, reinforcing their confidence, creating a self-fulfilling loop. Governments and institutions, seeing the surge of activity, begin endorsing the movement. Their approval adds legitimacy, which attracts even more participants, pushing the trend into territory far beyond its real economic strength. The narrative becomes louder, stronger, and increasingly resistant to criticism. Anyone who questions it is labeled pessimistic or outdated. This phase is not driven by logic, but by social momentum. People do not want to miss out. They do not want to be the ones who hesitated while everyone else moved forward. And so the enthusiasm becomes exaggerated, often detached from reality. Historically, this is when the most dangerous distortions begin. Asset prices stretch far above sustainable levels. Credit expands to support the growing appetite for participation. Media outlets shape the storyline to keep attention high. In many cases, influential figures become symbolic champions of the movement, presenting themselves as proof that the opportunity is real. What makes Act 2 particularly deceptive is its ability to feel natural. The rise appears justified, the excitement seems deserved. After all, there was an initial spark, a genuine innovation or discovery. But the amplification occurring now is engineered, not organic. It relies on psychological pressure, group behavior, and the subtle manipulation of expectations. And once a society reaches this point, the cycle accelerates. Structural imbalances deepen. Weaknesses hide beneath layers of optimism. The illusion becomes powerful enough to silence caution and fuel the leap into Act 3, where the emotional wave transforms into something far more calculated. Act 3 emerges quietly, often unnoticed, because the transition from euphoria to organized deception does not happen with a dramatic event. It begins with small adjustments, subtle shifts in policy, and behind-the-scenes decisions that seem technical on the surface but reshape the entire structure of the system. This is the stage where those who hold real influence use the momentum created in Act 2 to build mechanisms that serve their interests while convincing the public that everything remains stable. It is a calculated transformation, one that masks vulnerabilities with layers of complexity. Throughout history, this moment has always carried the same signature. In the Dutch Republic, it appeared when trading contracts and financial instruments became increasingly elaborate, allowing merchants to speculate far beyond their actual resources. In the South Sea Bubble, it emerged when political figures quietly expanded privileges for select investors while promoting the illusion of endless profitability. During the lead-up to the 1929 crash, central institutions silently inflated credit, creating an atmosphere where risks were disguised as growth. And before the subprime collapse, financial engineering concealed instability behind products that the majority of the population did not understand. The pattern repeats because the incentives remain identical. Those positioned at the center of the system gain the most when the illusion remains alive. Act 3 is not about chaos. It is about orchestration. Expansion of credit becomes strategic. Regulations shift in ways that benefit high-leverage behavior. Institutions begin presenting incomplete narratives to maintain confidence. market signals are softened or reframed, and gradually, the structure becomes dependent on artificial support. What once looked like a natural boom now relies on silent interventions that the public rarely perceives. This is also the stage where data becomes a tool of persuasion, crafted to reinforce the perception of stability while deeper fractures begin forming beneath the surface. The deception is not always malicious in appearance. Often it is justified as necessary to sustain growth, protect jobs, maintain economic health, or prevent panic. Yet the result is the same. Transparency fades, complexity rises, and the system drifts further away from reality. By the time society begins to sense discomfort, the machinery is already fully engaged, pushing the cycle toward its breaking point. And in this engineered calmness, Act 4 quietly prepares its entrance, shaped by decisions made long before the public realizes that the narrative has shifted. If any part of this stage reminds you of patterns you have noticed in today's financial world, share your thoughts in the comments. Your perspective can reveal how ordinary people experience moments that history often records only through numbers and charts. By the time a society transitions into Act 4, the atmosphere feels strangely divided. On the surface, everything appears functional. Markets continue operating, innovation remains celebrated, and institutions project an image of confidence. Yet beneath that facade, subtle signs of strain begin to emerge. Act 4 is the moment when the narrative crafted in earlier stages starts to collide with the reality that has been quietly building. This is where distortions can no longer be fully concealed, and the system enters a phase of tension that is recognizable only to those who are paying close attention. In previous eras, this stage revealed itself through unexpected fluctuations, sudden liquidity shortages, or abrupt reversals that contradicted the optimism of the preceding act. But what makes our current cycle particularly distinct is the technological layer wrapped around the system. Fintech platforms, instant credit approval, digital wallets, algorithmic lending models, high-frequency flows, and automated financial decisions form a web that accelerates both expansion and vulnerability. Money now moves faster than institutions can regulate, and confidence can evaporate with a single data trend circulating online. This acceleration creates an illusion of safety because digital systems appear efficient and modern. People mistake speed for stability, yet this very speed magnifies imbalances. When credit becomes frictionless, debt grows without awareness. When investment becomes gamified, risk feels entertaining. When financial products become simplified into apps, the complexity operating behind them disappears from sight. What feels empowering is actually pulling society deeper into Act 4, a stage defined by silent pressure, unstable foundations, and a deceptive calm that precedes crucial shifts. The challenge is that no one announces the arrival of this act. There is no headline that says the system has entered a critical phase. Instead, it is recognized through patterns. The increasingly aggressive monetization of innovation, the overextension of consumer credit, the normalization of digital debt cycles, and the reliance on algorithmic structures that function flawlessly until they suddenly do not. These signals, though subtle, are the same ones seen in historical transitions. The difference is that today they unfold with unprecedented velocity. This is the moment when Act 4 becomes unmistakable to those who study cycles. Not because the collapse has begun, but because the foundations supporting the narrative begin to shift. Investors grow more nervous, institutions become more reactive, and the public senses a tension it cannot fully articulate. It is the quiet turning point, the hinge between innocence and exposure, and it sets the stage for the next transformation in the sequence. As Act 4 tightens its grip, the transition into Act 5 takes shape with a clarity that is only obvious in hindsight. This is the moment when the structure, already strained by years of engineered optimism and hidden distortions, begins to reveal the consequences of its design. The exposure phase does not arrive through a single catastrophic event. Instead, it appears in fragments scattered across different sectors, nations, and markets. Small failures accumulate. Weak institutions begin to show signs of stress. Financial products once praised as innovative suddenly become sources of instability. What was previously dismissed as temporary volatility starts forming a pattern that can no longer be ignored. Historically, this stage has always followed the same rhythm. During the late stages of the South Sea bubble, investors who had once been confident began withdrawing quietly. In the months before the Great Depression, credit markets tightened even as public messaging insisted that recovery was near. Before the subprime crisis fully erupted, default rates rose incrementally, dismissed as statistical noise until the pressure became impossible to hide. These early fractures are not dramatic, yet they are decisive. They signal that the system is preparing for a deeper correction in nigh. Our current era, Act 5, is shaped by the interconnectedness of global finance. A liquidity issue in one region can ripple across continents in minutes. A shift in interest rates can destabilize entire sectors that were built on borrowed expectations. Fintech platforms that once promised efficiency now reveal how thin their buffers truly are. And digital markets, which move at a pace that defies historical comparison, amplify every tremor, turning minor fluctuations into global narratives. Within hours, this interconnected world accelerates both exposure and uncertainty. During this phase, institutions often attempt to restore confidence. They release reassuring statements, adjust policies, or intervene in ways designed to create temporary stability. Yet these actions, while calming in the short term, can inadvertently highlight how fragile the system has become. When a structure requires continuous support to remain standing, the underlying weakness becomes undeniable. And as the public begins to sense that the foundations are not as secure as once believed, a shift in collective psychology occurs. Trust becomes more difficult to maintain. Optimism requires more justification. And the cycle edges closer to a point where exposure can no longer be contained. What emerges in Act 5 is a quiet but powerful transformation. The narrative that once held society together begins to fragment. People start noticing inconsistencies. Markets react to signals that previously went unnoticed. And the illusion of stability, sustained for so long, loses its ability to persuade. This erosion of confidence marks the slow but inevitable progression toward Act 6, where the true consequences of the cycle are revealed. Act 6 is the moment when the quiet fractures of Act 5 turn into undeniable breaks. It is not simply a period of financial turbulence. It is the stage where confidence collapses as a collective event. For years, the system relied on perception to sustain itself. But once the veil weakens and the structure is exposed, the unraveling becomes irreversible. What distinguishes this phase is not the scale of the damage, but the speed with which certainty evaporates. People who once believed the narrative without hesitation begin questioning every signal. Institutions that projected authority start losing the ability to shape expectations. And the system, long dependent on belief, feels the weight of its own contradictions. Historically, this act carries the same emotional imprint. During the final moments of the Tulip Mania, buyers who had blindly pursued bulbs for extraordinary prices suddenly refused to participate, leaving sellers desperate and valuations meaningless. In the aftermath of the South Sea scheme, panic swept through London faster than any political reassurances could counter. The crash of 1929 showed how quickly liquidity can disappear once the crowd senses that the story holding the market together no longer makes sense. And during the subprime collapse, the recognition of systemic fragility spread like a contagion. Not because every institution failed at once, but because confidence did. In the present era, this stage is magnified by digital connectivity. Rumors become market forces. Viral information reshapes valuations. A single data point can trigger global reactions within seconds. This interconnected panic creates a feedback loop. Uncertainty fuels volatility. Volatility fuels fear. And fear becomes the dominant force guiding behavior. Financial systems built on complex algorithms find themselves reacting to psychological shifts that no model can fully anticipate. And as institutions attempt to contain the fallout, their interventions often reveal more weakness than strength. Act 6 is also the moment when long-ignored imbalances suddenly gain visibility. Debt structures designed to function only in conditions of optimism become unstable. Sectors inflated by artificial demand lose their support. Governments confront the consequences of decisions made years earlier. and individuals who once trusted the system feel a sense of disorientation, as if the ground beneath them has changed without warning. This emotional shift is critical to the sequence. It dissolves the last remnants of the illusion and prepares society for the harsh clarity of Act 7. If you have noticed signs in today's world that resemble these historical turning points, leave a comment sharing your perspective. Your view helps illuminate how ordinary people experience changes that history often describes only through statistics. As the collapse of confidence solidifies, the transition into Act 7 begins, not with hope, but with resignation. It is the stage where the system no longer attempts to preserve the illusion that defined the earlier acts. Instead, the focus shifts to managing the consequences. What makes this moment so defining is that the narrative finally breaks open. The mechanisms that once operated invisibly become visible. The risks that were dismissed as improbable now stand at the center of public discussion. And the cycle enters its most painful but clarifying phase, the systemic reset. Throughout history, this act has repeatedly unfolded with the same structural logic. After the unraveling of the Tulip Mania, Dutch authorities tried to stabilize markets, but ultimately accepted that prices would never return to their euphoric levels. In the South Sea aftermath, Parliament stepped in with corrective measures that exposed political entanglements once concealed behind false prosperity. After the Great Depression began, governments introduced emergency interventions that reshaped entire economic frameworks for decades. And following the subprime collapse, systemic reforms emerged only after institutions admitted that the previous structure was unsustainable. In every case, the reset did not restore the old system. It replaced it. Act 7 is characterized by forced transparency. Weak institutions either restructure or disappear. Debt that was once ignored must be confronted. Policies shift from expansionary to defensive. Markets adopt new rules designed to prevent the previous excesses. And central authorities, whether governments or financial regulators, attempt to rebuild trust through frameworks that align more closely with reality. These transformations do not occur smoothly. There is resistance, uncertainty, and discomfort. But the reset is unavoidable, because the system cannot function without redefining itself. In the modern cycle, this phase is intensified by global integration. No economy resets in isolation. A financial correction in one major region affects currencies, trade routes, investment flows, and political alliances worldwide. Fintech platforms must adapt to stricter oversight. Digital infrastructures face new security requirements. Consumers reevaluate their relationship with credit and risk. And markets learn to operate with constraints that seemed unlikely just a few years earlier. Although this process can be destabilizing, it also serves a crucial purpose: clearing the distortions accumulated over years of artificial expansion. This act does not bring conclusion or stability yet. Instead, it clears the ground for what comes after the reset. The old structure, once seen as permanent, fades. A new version of the system begins to take shape, influenced by lessons that were ignored until now. And, as society adjusts to this transformation, the foundation is laid for the cycle that inevitably follows, signaling that even at the endpoint of the sequence, the pattern is preparing itself to begin again. When the system emerges from its reset, something fascinating becomes clear. The 7 acts were never isolated events. They were expressions of a deeper pattern that has shaped financial behavior for centuries. This is the invisible cycle that lives beneath the surface of every market, every innovation, every shift in monetary structure. People often look at crises as standalone anomalies, but history shows that they are chapters within a repeating narrative. The actors change, the technologies evolve, but the psychological and structural foundations remain almost identical. Across different eras, cultures, and economic systems, the same core behaviors emerge. Hope transforms into euphoria, euphoria into distortion, distortion into collapse, and collapse into reconstruction. What varies is the disguise. In the 17th century, the mania centered around tulips. In the 18th century, it revolved around colonial ventures. In the 20th century, it was industrial expansion, stock speculation, and housing markets. Today, The cycle manifests through digital finance, algorithmic predictions, speculative cryptocurrencies, synthetic credit, and frictionless debt. But the underlying mechanics have not changed. Human belief remains the engine, and perception remains the fuel. This invisible cycle thrives because most people interpret financial events through the lens of the present, not through the continuity of history. They assume the current moment is unique. They trust that innovations make the system safer. They believe that modern tools eliminate old vulnerabilities. And yet every generation eventually discovers that complexity does not eliminate risk. It only hides it more effectively. The cycle repeats because societies repeatedly underestimate the emotional and psychological drivers behind financial behavior. Another key aspect of this hidden pattern is how institutions respond. Whether they operate in monarchies, democracies, or digital economies, central powers consistently attempt to manage the cycle rather than break it. They adjust interest rates, create new financial instruments, impose regulations, relax regulations, expand credit, or restrain it, all with the intent of sustaining stability. But these interventions often reinforce the very behaviors that lead to excess. The illusion of control becomes a catalyst for greater risk, and the cycle progresses toward its next iteration. This repetition across centuries suggests that the 7 acts are not random, but structural. They reflect the tension between innovation and speculation, optimism and reality, expansion and limitation. They show that financial systems are not purely economic constructs, but psychological ecosystems shaped by collective belief. And once a society completes the sequence, it unknowingly prepares the groundwork for the next cycle, convinced that the lessons learned will prevent the pattern from returning, even as the seeds of the next Act 1 are already forming beneath the surface. As the full sequence completes itself, another realization begins to surface. Even after the reset, even after the system restructures, even after the most painful corrections take place, there is always an 8th movement shaping the future. It is not an official act, nor a dramatic event. It is a silent transition, a phase defined by uncertainty, reconstruction, and the gradual emergence of new narratives. This is the moment when society tries to understand what comes after everything it believed has been dismantled. People look for direction, markets search for equilibrium, and institutions attempt to rebuild trust through new frameworks that promise stability while carrying the imprint of the previous cycle. In every era, this post-sequence environment feels strangely familiar. After the Tulip Mania, investors convinced themselves that more rational markets would prevail. After the South Sea collapse, policymakers insisted that safeguards would prevent similar speculation. After the Great Depression, societies believed that stronger institutions would forever protect them. And after the subprime crisis, the world embraced digital finance under the belief that technology would solve the vulnerabilities exposed by the collapse. Yet, each time, while the surface appears transformed, the underlying forces begin arranging themselves once again, preparing the psychological landscape that gives birth to the next Act 1. What unfolds during this phase is a subtle rewriting of the financial narrative. New opportunities are presented as solutions. Innovations are framed as protection against past mistakes. Technologies are introduced as tools that will finally eliminate risk. And slowly, without anyone fully noticing, the first seeds of the next cycle are planted. People begin to believe again, cautiously at first, then with renewed optimism. The desire for growth returns. The belief in control strengthens. And the architecture of a new story starts to form, shaped by lessons that societies think they fully understand, even though history shows that understanding alone has never been enough to break the sequence. What makes this moment so crucial is that individuals have the rare opportunity to interpret the system with clarity. After a reset, the illusions are at their weakest, and the signals are at their strongest. Anyone who pays attention can recognize the structural patterns repeating. They can see how innovation becomes narrative, how narrative becomes momentum, and how momentum becomes speculation. This awareness does not stop the cycle, but it allows people to navigate it with intention rather than instinct, using the past as a lens rather than a distant memory. And as this quiet transition unfolds, the cycle prepares to begin its journey again, reshaping the world through familiar movements disguised as new events. It is at this point that understanding becomes more valuable than prediction, because those who recognize the pattern before it fully forms are the ones who adapt rather than react, interpret rather than fear, and position themselves with clarity rather than confusion. If you stayed with me until this point, leave a comment saying the phrase "I am with you until the end," so I know you followed the full sequence. And if this content helped you see the system with clearer eyes, consider subscribing to the channel so you do not miss what comes next. A like on the video also helps this discussion reach more people who want to understand the patterns shaping our financial reality. And if you want to continue expanding your perspective, there is another video right here that connects directly with everything we explored today. Click and continue with me on the next step of this journey.